Thanks for staying with us. Now, Kenya Airways has been contracted to uplift 30 tons of cut flowers a month from Nairobi to Australia, a major game changer for Kenya in terms of increasing trade exports of flowers to non-traditional markets, thus generating revenue. Jean-David Mahamli and Kenneth Kari reports.
The horticulture industry is critical for Kenya's economy. The sector plays the exact role as oil does for Nigeria, cocoa for Ivory Coast, or diamond for South Africa. It's a strategic resource that earns the East African nation more than $1 billion annually. In 2015, the sector contributed about 1.5% to the national gross domestic product. The industry also supports at least 500,000 people in the country. The sector has been attracting investors due to solid infrastructure, favorable climate, global positioning of Kenya, and a productive workforce. The Kenya Flower Council says the sector has been recording an annual growth of 5%. Kenyan flowers are sold in more than 60 countries. The main cut flowers grown in the country are roses, carnations, and alstroemeria. The East African nation is the lead exporter of rose cut flowers to the European Union, with a market share of 38%. Approximately 50% of exported flowers are sold through the Dutch auctions, although direct sales are growing. Industry players are, however, aiming higher and are now targeting the Australian market. Hence, recent agreement signed between Kenya Airways and the Australian airline Qantas to deliver to Australia every month at least 30 tons of flowers, which are harvested in the nation. Going forward, the Kenya Flower Council says the industry will continue benchmarking itself against other producer countries.
About a week ago, AngloGold Ashanti, Africa's biggest gold producer, planned laying off more than 800 workers at its South African operations after years of declines in output. But Monday, the National Union of Mine Workers succeeded in negotiating an agreement to avoid retrenchment. Victor Monsieur and William Bahia with the inside story.
Africa's biggest gold producer, AngloGold Ashanti, will hold back on job cuts announced last week at its South African operation after years of declines in output in the country due to regulatory issues. The company said it will instead redeploy most of the workers within the firm, the National Union of Mine Workers confirmed on Tuesday. The company employs about 25,000 people in South Africa, whose vast resources are accompanied by the risk of volatile labor relations, rising costs, regulatory disruptions, and dizzying shaft depths. The talks come about 2 years after AngloGold shelved plans to separate its local mines by spinning off its international assets into a new London-listed entity that had hoped would have attracted a higher investor rating. AngloGold maintains that the layoffs are important in ensuring the creation of a more sustainable and cost-effective enterprise that better reflects the realities of the operating environment. Output from AngloGold South African mines, which contribute roughly a quarter of the company's nearly 4 million ounces in annual output, has been declining in recent years due to regulatory disruptions related to safety. The spokesman for the National Union of Mine Workers, which represents the majority of workers in the sector, said his union looked at the matter with serious concern. Solidarity Trade Union's General Secretary Gideon Duplessis said the layoffs did not come as a surprise because the company had been in consultation with union leaders for a few months. AngloGold operates in 8 other countries in the world, including Brazil and Ghana.
And that does it for this week's edition. Get interactive via our social media platforms in English and in French. Join us again same time next week.